of events that we're focusing on new and emerging managers. And as you know, VC Lab really focuses on closing a fund. And what this part of the session or this session is about is sourcing deals and building that deal flow that you need in order to actually deliver the results to your LPs. So we're going to be talking mainly about sourcing. We have three amazing managers who are part of Decile Partners. We have Ihar from Geek Ventures, Jonathan from Capacity, and Ali from First Check. And these guys are really part of our major sources and create a lot of deal flow and make a lot of investments as well. So I'm going to look for you guys to introduce yourselves. Ihar, let's start with you.
Sure. Thank you for inviting, Neil. So my name is Ihar Makhanyok. I run Geek Ventures. We started as a firm 3 years ago to invest in immigrant founders in the US. I have been investing since about 13 years ago. I was one of the first investors in Instacart, PandaDoc, People AI, and in total 5 companies went all the way from seed to unicorn where I invested. And I have had originally a software engineer training and worked at Google and Facebook as an engineer. And yeah, I'm based in New York, and really sourcing is a very dear topic for me. So happy to chat about that.
I'll go next if you want. I'm
Perfect.
John Bragdon with Capacity Capital. I just came over to the funding side of the table as a fund just a couple of years ago. Most of the time in my past has been building companies, so still a founder at heart, and will always be that way. So this is pretty critical to me, this whole discussion around where do these deals come from? Because when I hear deal, I hear entrepreneur and founder and opportunities that can turn into something big. And so finding those deals is really a big relationship play. So I'm excited about talking about this. We're focused. Capacity is more focused on the Southeast U.S. So we do have a geographical range that we look at, but we look at all types of companies that are, we're early, but we look at these really early stage deals. So they're fun to find. So look forward to talking about this.
Hi, everybody. I'm Ali Jamal. I run a firm called First Check Ventures. And even though I guess now I'm a VC, I don't tend to think of myself like a VC. I think Ihar, Jonathan, also, I think that's part of the reason why we all get along so well is I think we all kind of still think of ourselves as, startup people. And so, I've spent the last 2 decades working in startups, both in Silicon Valley and then all over the world. Most recently led growth for a couple of different unicorns in Latin America. I started running an angel syndicate back in 2020 and, had been doing angel investing before that for more than a decade. And so really excited about the idea of what a first check represents and being able to be that first person to really come in and believe in people and support them. And I think that's a key part that's missing in a lot of venture is really being able to not just be the financial support, but also the emotional support, the intellectual support. I think it's extremely important to really be value add as an investor and as a partner with early stage startups. So I'm really excited that I get to play that role.
Thanks for those intros. So I want to kick this off by talking about deal sourcing strategies and what you guys find are the most valuable ways of really getting those hidden gem deals, getting into the deals that you really have conviction and belief on, and what drives your conviction in the deals and in the specific channels that you really focus on. So anybody want to start with that, and we'll just go around?
John, go ahead.
I think for me, being the first check, it's really all about the founder. And so the biggest thing that I try to do is talk to as many founders as I can. I think, when I look at a lot of VCs out there, you know, they typically will talk to 30 or 40 founders a month. I talk to 30 or 40 founders a week. And so really trying to get out there and get to know people, because when you're coming in early, it really is all about the people and you know, can they execute well? Do you share the same vision? Right? They like so often what you invest in is it what actually ends up slowly getting built. And so do you trust them and can work with them and you know, can they take feedback and adjust and change and evolve, right? And so for me, it's really trying to understand how people are and trying to talk to as many people as possible to figure out who actually kind of shares that same vision that I share.
So two quick follow-ups for you on that. One is, how long do these relationships, for one, if you're talking to 30, 40 a week, how do you manage all these relationships? How do you even keep them in context when somebody comes back to you 2 years later and you're like, well, we had this conversation. How do you track that? And how many are you tracking? And how long does it take for you to build those relationships into an actual investment?
So, you know, usually on the call itself, I will try to give people next steps. So if I think it's, hey, we should talk again in 6 months, I'll tell them that. If it's, hey, this isn't a good idea for me, but I like you, I'll tell them that. If I'm just like, I don't think this is a really great idea, and I don't know if I really like you that much, I probably wouldn't say, you know, much about next steps either way. But you know, it ends up kind of just being able to actually set that pattern of, is this somebody that I want to talk to again? And how quickly do I want to talk to them again? There's some people who are like, hey, let's talk again next week, or let's talk again tomorrow. And when there's somebody who I keep on saying I want to talk to them again tomorrow, that's when I kind of get excited and know I want to come in and potentially invest.
Jonathan or Ihor, you want to follow up on this?
Happy to add. Yeah, so in general, what is important is the network, right? So for us, this is one of the things, and I want to say that I spent a lot of my effort and time on building relationships with other investors, including very early stage angels, accelerators, smaller pre-seed funds, and basically because that's what Neil, you asked about, like how the relationship building, and I find that it's very important for to be a successful investor with a good deal flow. It's very important to build relationships with people who can who know many founders, right? So to basically try to keep in touch with them. You know, I met Jonathan, but I am in touch with Ali, and for example, we are always for every couple months we exchange deals and ask each other what's the most recent deal and what's interesting on your plate, and this is how the best deals come to me.
Jonathan?
Yeah, I 100% agree with all of that. It's relationships, and in fact, right before this, I was off the phone with another fund talking through a deal. I think that's a core piece of just trading things that may fit both the funds or may fit one and not the other. So you're constantly trading things around, um, because if that fund has spent time with a founder, they're going to have some insight, you know, give you a head start on what's going on. A couple other angles, I do agree with. I go all across the Southeast U.S. to events, and I know all the accelerators and incubators, but also get involved in some of these events. In fact, yesterday I was in Charlotte for it's called a reverse pitch, where there were 12 funds up on a panel basically talking about companies that they were looking for, and the entire audience is founders. And so sometimes, you know, those work really well. But I think the most effective that we've had has been really the one-on-ones. I mean, Ali talks about talking to 30 founders a week. We talked about 20. But a lot of our conversations, and this is a little different than most funds, but we talk a lot about whether they should be raising venture capital in the first place. These are early stage companies. Like VC should be their last choice. And so the conversation moves into other alternatives or different types of capital stack. And there's a couple things going on there when when on these 20-minute calls, I'm analyzing whether a founder can adjust their strategy, whether they listen, whether they're coachable. If I introduce them to people, will they follow up? And I get to do some due diligence without ever writing a check, and can watch them operate over the next 3-4 months. And sometimes, like Ali, there's a follow-up, sometimes there's not. But there's a little bit of a relationship, but we get to observe each other, whether, you know, we can be helpful to them or not. Because, you know, frankly, most VCs are not helpful at all. And so figuring out where that connection actually fits is pretty key. So we do that, I guess, the hard way. We spend time on it.
I think there are a couple takeaways from this point. One is that cultivating relationships takes time. This is really effectively a full-time job, right? I mean, your first full-time job as an emerging manager is to raise your fund. Your second full-time job is to cultivate your deal flow. So, hey, sorry, that's two. And the other thing that I would take away from all of you is that there's a level of trust and transparency that you build with your founders. The feedback needs to be, you know, you're not sugarcoating it. You may not say you suck, but or your idea is really shit. But it's like, you have conversations with people where developing that transparency and trust will definitely flow into other relationships. And I think the point that I would raise is that having good relationships with founders leads them to network you into other companies, even if you're not interested in that founder or not going to make that investment. That founder may refer you to somebody else who really does fit. So
this is actually just to double down on this. This is exactly true. So that's sometimes I take a call with the founder, even if I don't really like their idea, but if I like their background and there is like some signals that this founder is really strong, and I try to maintain those relationships. And one of the best deals I have made as a investor was People AI, where I invested very early, and now it's a unicorn. I was introduced to the founder by a founder of another company that I didn't invest in. And there was specifically the story that I spoke with that founder, passed on his company, but he liked my feedback enough, and he liked how I approached it, that he went out of his way to introduce me to the promising other founder he knew. And I still get this kind of deal flow this year.
Yeah, that's the best. I mean, because you've proven trust with a founder, and as us, the three of us being founders before, that's hard to come by. So if you can get that third party validation from another founder, there's same here. I've had a couple deals from that too that I really value that piece.
So let's dig in a little bit on the past experience as, operators, developers, founders, and how that helps you in the selection process, right? We've got emerging managers in VC Lab and in Decile Partners who come from all kinds of different backgrounds, some from pure finance, some from being operators like you guys. But how do you take that and translate it kind of into that intuitive, I'm going to focus on this deal? How much of it's intuitive? How much of it is at a seed stage is some sort of metric that you can apply? So how much of it is a process and how much of it is gut?
I can jump into that. I think what is very important is the funnel process, at least for us, right? We are really focused on making sure that we are looking at as many deals as we can, and we are trying to also increase both quantity and quality of our deal flow. Right now, we are looking at about 3,000 deals a year, but we want to do more, 4,000 and 5,000. And in order to be able to process so many deals and not miss, you need to have a process. You definitely need to have a process. And we are building this process internally, and we're improving it all the time. But for example, we receive about 100 warm intros a month, and we get about 100 to 200 cold inbound a month. And on every deal, we look at the deck and all the information we can find about the company before we decide whether we meet or not. And this decision is informed, and we have about typically 10 minutes, 5 to 10 minutes, sometimes less, sometimes more, to decide whether we want to meet. And we have plan to meet with about 50 to 70 new companies a month, right? So, and which means that not every warm intro that we get, we meet the company. And of course, not every cold inbound that we get, we end up meeting the company. And that's important. And then on the next step, we want to, out of the companies that we actually met, 50 to 70, sometimes more a month, we want to narrow it down to about 10 on which we actually go deeper on due diligence, right? So, and we have the process where we as a team have a very quick discussion, or sometimes a person who just took a call makes a quick informed decision on whether to pass or at this stage, or move to the actual due diligence.
So how many people on your team, Ihar?
We have 5 people right now. We have 3 people on the investing team right now, and 1 more person, 4th person starts on Monday.
Yeah. So thinking about a lot of the managers who are on this call are the managers who are going to form funds where they're really solo operators, right? You know, considering the size of your deal flow pipeline and the funnel, you know, given much more limited resource, maybe Ali or Jonathan can jump in and say, how do you handle that volume with, you know, with a smaller team?
Yeah, we have a very similar volume at this point, and it's incredibly difficult. We probably have to, that first cut of companies coming in, we cut pretty deep, and because it's just impossible to follow up with everything that's coming in. But if we've got enough information to figure out if it fits within our thesis, then we get to a second piece as well. We're really focused on the way our funnel works. We end up focusing pretty heavily on the business model itself. Like we want line of sight to 12 to 18 months. We want the potential to break even. So that becomes pretty easy to filter with a quick pro forma, and you can study in 5 minutes what the margins and what they see. So that's another quick cut. But we do over index on communicating with who's left. And that just, it just takes a lot of time. And we have some signals that we do look for. Again, as former founders, you do have a sense for this. So there's some quantitative pieces, but there is some gut around whether a founder really is completely obsessed over something, or whether they're just enticed by the startup culture, right? You can see the difference. You also can tell really quickly if they can articulate the problem just precisely, because the product or the service, however they're going to solve that problem, is going to shift over time anyway. But if they can articulate the problem and it's truly compelling, and you can line up what they've done with how to solve that becomes a pretty small group of people in the overall funnel. So we look at that. We also, and we tend to look at 2/3 of our founders are women, or founders of color, or veterans, and a lot of athletes, and the things that have in common. One of the data says that they perform better as founders, even coming from a white guy. But the other piece of it is they just tend to look at barriers as gates, and looking to level up, and that it takes that type of personality and perseverance and obsession to get to the next level as an entrepreneur. So we look at that.
Thanks. Ali, you want to build on this?
Yeah, so I think one of the biggest things is, I was initially kind of coming in at, kind of more of the seed, pre-seed type stage, and typically coming in, at valuations between 15 to 25 billion. And so you kind of had a certain expectation of what the company was like and what the founders were like. And over time, I've continued to kind of go more and more upstream, and really kind of try to double down on the idea of being a first check. And so, I think a lot of what I'm now kind of looking at or working with is realize that I might be their first VC contact, right? Or the first time they're really pitching this, or the first time they've really made a deck. And understanding that there's going to be an evolution between this deck and the deck that ends up getting funded in 2 or 3 months. And so try to see, even at the early stages, is there some nugget of you know, gold in this, right? That I can go and polish. And so I tend to be a little bit more liberal with kind of meetings and really try to um, get into a meeting with the founders so I can talk to them and understand them. Because I think things don't always come across as clearly in a pitch deck when you're starting out day one. And I think all of us, when we made our first pitch deck for our funds and our first thesis statement and when we went through VC lab and all these kinds of things, the evolution from day one to day 15 was huge. And so just kind of take that same knowledge in when you're working with founders. Is there stuff good here that's worth having a follow-up? Is kind of really more of my talk rather than try to cut too many from from conversation.
I would amplify 2 points here. One is that, and maybe I'm a bit contrarian, but the fancier the deck, the less likely I am to follow up in many ways, right? Because when I see super polished decks, I almost think that this is targeted at a retail investor. And as somebody who's looking for a hidden gem, I'm perfectly willing to dive in and work with founders and help them. And I see that as part of our value, is really helping them articulate and as a VC, helping get other investors and helping syndicate the deal or lead the deal. And if the deck sucks, but there's a nugget of beauty there, there's something in there that really says this founder has it, they have the passion, or they really fit. This is, they're obsessed with this solution or with this problem for some reason. If I can see that, that's what I'm really looking for. The thing that I really also want to see is I want to see a realistic, in my world, realistic understanding of the competitive landscape. We all look for founders who are kind of on this line between optimistic and delusional. And, delusional can't be, I'm the only person who's ever thought of this idea, unless maybe they are, but then they might be, that's a whole different question. So thinking also about as you look at these presentations, as you dig in with founders, Jonathan talked about some really interesting green flags. What are the other green flags and red flags that you guys look for? Things that'll say, damn, I really want to this is somebody I want to pursue, or now this is like, that there are probably a few red flags that are like, yeah, I've got to punt on this one.
So I think kind of one of the things that Jonathan had kind of brought up earlier, right, is VC shouldn't be your first step. So like if you just have an idea, you put a pitch deck together and the first thing you do is go and email it to a bunch of VCs, I get weirded out. Right? So the green flag for me is how much work have you done to get to this point, to de-risk it, to now where funding is the only real thing you can do. So you've already bootstrapped it, you've already got a prototype, you've got some revenue, you've got some customers, you've got feedback, like all those sorts of things towards traction to prove that this is real, and not just for you, right? But also like to prove that the company is really worth it, right? Because the thing that the founder has to realize is that this is the cheapest that their company's ever going to be. And so, if they really want to sell off so much of their company super cheap, maybe they don't believe in their own idea, right? So like that's always kind of like the biggest kind of green flag, red flag for me is how much have they actually done? How much work has been put in? And how much do they realize about what VC is going to come in and how they're going to be helpful and, do all those sorts of things matter to them? And have they thought about how they're going to like kind of continue to manage their cap table? How much have they given up of their cap table? Who are they giving it to? Those kinds of questions I think are really things I try to dig into.
Building on that real briefly, I basically every founder and almost every VC that I talk to, if they haven't read it, I send them a link to go buy Brad Feld's book called Venture Deals. And that I see part of our value as ethical venture capital firms is really helping companies understand what that capital pathway is, and we will, you know, I'll either gift them a copy of the book, or at least give them the link and go read this before you have your next conversation if they're not fully aware. Because to Ali's point, some of this unawareness is because the venture industry tries to be opaque, and that's one of the things that we're really trying to fix with both VC Lab and Founder Institute, I think. Ihar, thoughts?
Yeah. So I think that the major green flags are all about the team, right? So, and to be fair, that sometimes we invest in a company where the team slide is not like popping in your face, but it's if it is, then we definitely take a call and we dig deeper. And for example, one key thing is that CEO has worked for like 10 years in this industry. CEO knows all the key buyers and purchasers in this industry. This is a key. Another thing, of course, is investors, especially angel investors. I would recommend everybody to try to get notable angel investors with notable names or titles or companies as early as you can. And I think that I still meet some founders that just don't want to take money from angel investors, which is wrong. Taking money from notable angel investors that can help you connect and will also stand out in your deck is a really good green flag. And of course, the traction, both annual and month over month, especially most recent months. If you have been growing like 15%, 20% the last month, or double the last month, that should be front and center, right? So this kind of stuff.
Yeah, I can add to that too, because double down on all of that. I think there's a trend that's happened over the last 10, 15 years that for some reason a lot of new founders think venture is to start a company. And what's been lost is it's always been money to scale a company. So you've got to have something to scale. So this first piece of this, angels have a really important part at that really early stage. Even if it's just for the founder to have somebody alongside them in a network, and even if it's very tiny checks. So we don't mind if an angel's in first, but red flag, green flag. Red flag is for us is if that cap table is just really got all kinds of stuff in it and different valuations, and it's really difficult to work with. So it's important for a founder to understand sort of the sequence of capital. They're not just chasing a check. And if they're talking about when we're talking to them and they're asking, well, we need 500 grand or we need $1 million, and how's that fit into what you're doing? Use of funds, how does it fit into your financial structure? If they can't answer that and they're literally just looking for money to make it work, that's a huge red flag because they just haven't done their homework yet. And that's part of what we've tried to do on the side is really help them with that a little bit. Another thing that's important to bring up, I think, is kind of going back to the relationship side. If you meet with a founder, when we meet with a founder, we can and have a face-to-face, whether Zoom or even in person, preferably. One question we really ask is, could we work with this person? Because at the end of the day, you're going to be working with this person for 5 to 10 years. It's not just a transaction. Like you're giving them a loan and hopefully they do payments. Like we're trying to create value together, and you're going to have interactions. There's going to be tough times. Building a company, is really damaging to a person. There's a lot of fatigue and hurt. So you've got to figure out a way to go through all those hard times. And if you can't get along with that person, don't think you can work with them. There's no point in starting a relationship that way. So.
I'll add to that, which is that you need to build, I would call it transparency and trust, because there are certain funds who are famous for coming in at later stage and just saying, we're just going to crush all these early investors. And, as an early investor, you do not want to get diluted 8 to 1 by some fund that comes in with a really sexy big check. You want that founder to stand up for you and say, no, we're going to you know, even though this is going to be a significant investment, and even though it's sexy as hell, we're not going to screw over our early investors. We're going to do something that's rational. And you want somebody who, if you're the expert on capitalization and you're providing that support, you want a founder who's going to bring you in early in those conversations, and that's part of that long-term relationship that you're trying to build and with the founders. And if things are going to go sideways, which they do, right? You want to know earlier rather than later, because if the thing's already basically destroyed, you can't help. But if it's on its way or if it's going sideways, you know, somebody brings you in, you might be able to help even by doing an M&A activity or something like that, where advance warning can turn a bad investment or turn a potential into something worthwhile.
We've been working on something around that early warning. In the first fund, one of the required terms we had was online access to their books. We didn't require a board seat because our goal was to get them to the next round, and we wanted everything to be as clean and frictionless as possible. But we found if a founder, because I was this way, if a founder knew the investor could see what was going on month to month at minimum, then when something happens, like say they lose their biggest customer, they're typically going to reach out first, say, hey, you're going to see this show up on the books. I'm thinking of trying this, and you can work on it because you work on problems together. Instead of, 3 months later in a board meeting, you find out about something that happened. It's already festered and it face planted a couple times, or worse, you don't find out about it because, they sort of, and that goes back to trust and openness and transparency. So that's one thing we've tried on the term side as we do some of these deals, because it's also a good indicator from a founder of how they want to work. Right?
Ihar, you've got a lot of fair number of actual investments and a fair number of markups in your in your portfolio as of now, I think. So
Yeah.
in terms of the takeaways that you've made and in terms of where those deals came from, is there any one particular thread that you would a couple of threads that you would pick out beyond what we've talked about here?
Yes. So we analyze where our companies that we invest in come from, and we have invested in about 50 companies out of Geek Ventures, and so far about 96% of them came through warm introductions or previous relationships with the founders, and a lot of about half of those came from investors we basically were tipped about this company by somebody who's on their cap table, and about half came from somebody who just knew the founder but was not an investor, was not on the cap table. And what I see to this is that it's extremely important for VCs to build relationships with other VCs, and also especially if your check is small enough to be collaborative. We are investing up to $500,000, so we can easily fit in like 2 million, 3 million round without pushing anybody out, right? So we don't require like 10% ownership right now or anything like that. And if your check is even smaller, like 100K, this is the golden mine, right? So make sure that you talk with other VCs and look for the opportunities where the companies that other VCs are excited about. And we do it opposite as well, right? So when we invest in a company and they have room, we always tip off other VCs who are in our orbit. And it's such a mutual benefit thing, is that if I talk to a VC and they tell us about their companies, we tell them about our companies, right? So, and of course there are asymmetric relationships. So sometimes, for example, we talk to accelerators and pre-seed VCs. They couldn't invest in our companies, but we can help their companies by investing in them. And on the opposite, when we talk to Series A funds, they don't help us with our deal flow, but we help them with their deal flow. And it's very important to basically, for every VC, to keep this part on your calendar where you're talking to other VCs, other accelerators, and so on. And wait a second. back to you. And on the other hand, what is really important is this for founders is cold inbound gets ignored 90% of the time. And when it's looked at, where we look at that, it doesn't get as much weight as when somebody who has a trust and respect vouches for you. It's very, very different when somebody vouches for you and they actually tell some other VCs why they're excited about your company.
Ali, have you seen, you look at both cold and warm. Have you got any really awesome deals from cold inbound that you believe are on a trajectory to really return?
Yeah, I invested in a pre-seed company that was just a cold LinkedIn message, and they're now raising, or they just raised their Series B. And with very significant large co-investors. So I think, for me, it's always good to at least look at the pipeline and not discriminate about where things come. I do, love a great warm intro. But what I find is that a lot of the warm intros that come in aren't really warm, right? Like it's oftentimes people reach out and, ask for an intro to me. And the person that is offering the intro is like, I don't know these guys. I worked with them once, 10 years ago. I didn't really think he was that good back then, but he asked for an intro and I don't want to say no, right? And so I find like, and so one of the questions I ask every warm intro is like, do you actually like this person? And two, would you actually write a check to them? Right. And if the answer is no, then what's the point of the warm intro? So I do love it in theory when it's somebody that's already on the cap table or somebody they would definitely invest in, and then the warm intro is great. But I think everybody's looking for these warm intros. Everybody talks about how important warm intros are. So everybody goes to get warm intros, but I think most intros that happen are more lukewarm than actually hot.
Yeah, and to add to that, the really biggest mistake you can make as a founder is ask a VC who is not investing to introduce you to somebody else. It's like, and I get this request all the time. It's like when I say, sorry, this is not fit for our fund, they ask, can you recommend us to somebody for whom it's a fit? It would be bad, because if somebody who is a VC who has money to invest sends me a deal and I ask them, are you investing? They say no. I'm like, why are you not investing, right? And then they basically tell me the bad stuff about the company. It will be really not a warm intro. It will be bad for you.
I mean, there've been,
That's true a lot. I would also, I do see some of the other side too, where you've got, this is to your point, I hear about having to know a lot of, be talking to a bunch of other funds, which I should do a lot better at. But you get some of that, but you also get I get some where it's like, man, I wish I could invest. It's too early, or it's not in my geographic region, or, whatever, but I really like this. So that does carry a little bit of weight, but I do there are a lot that come in with just, yeah, don't ask me too many questions, but here you should talk to them. I will say the number one, what goes way to the top from a weighted introduction is the founder introduction. Some other founder has introduced another founder and said, you should take a look at this. That goes way up at the top. So if it's somebody I respect. So.
And I've done some where, the worst ones are where, and I think, as a manager, you need to be aware of your social capital and but the worst ones are people who abuse LinkedIn, right? They reach out, you have no idea, they don't know you, or they mention somebody who doesn't know them, or, when I was less discerning in my LinkedIn acceptance, I periodically would get feedback from somebody who said, oh, this person's connected with you on LinkedIn, therefore your credibility extends to them. And it's like, no, it doesn't, because I was connected to them through some other second level connection. And now I get, each of us probably gets 20 or 30 or more LinkedIn requests for connection a week, even though on my LinkedIn profile, I'm like, don't pitch me here, pitch me somewhere else, right? Send me an email. So, and if somebody's pitching me on LinkedIn, they clearly haven't even read that. But yeah, I think The challenge is for the cold, cold intros, there may be a hidden gem in there. And you can't automatically disregard them, but every once in a while, there is
Sure.
something worthwhile. Love to open it up for questions in our last few minutes. We've got a few that have come in. If you've got a question, type it into the little Q&A section or the Q&A menu in Zoom. Let's see. Let's see if there's anything here. Checklist manifesto for first line of filtering. So I think what we're hearing is that it's human, right? We'd love to have there are definitely points that you look for in terms of green and red, or pass it, or move it onto your next stage. But anybody have a quick checklist beyond, I think
Happy to jump in, right? So first of all, there is obviously limitations, the constraints, when companies are blasting out their cold out, they miss it. Like, for example, we only invest in the US. I mean, the company is like European-based company or Asian-based company. We just have to reject it right away. But other than that, we look at whether they are raised at the right stage, and often it's when it's not always obvious from the deck and initial outreach, but sometimes it's obvious that the company is in the wrong fundraising stage for us. And here, how we look at it. First of all, we only invest in young companies. And one of the things that we are checking is like, if the company is more than 4 or 5 years old, we don't consider it. Second is if, and by the way, we prefer companies under 2 or 3 years old. So 3 or 4 years old companies is also a little harder for us. But then we also look at if they have a size of the round or valuation listed in the deck or previous investments. We also look how it matches with the company, with the team track record and the traction. So for example, if the team never is the first time founders, they never launched anything before, and they also don't have traction, so it's a typical first time founder pre-seed, and they're asking for 10 million valuation, then we'll probably not, and unless it's like some crazy, amazing, like unique idea, it's very unlikely that we'll talk to them at that stage, right? We'll ask them to, come back to us with more traction to basically justify your 10 million plus valuation. So this is like but if your team has a significant previous experience or has traction, then it's another thing. Yeah, so to you guys.
I think for me, it's just like a really simple question for this checklist. Like, do I actually care about this? Like, do I actually want to see this company exist? Do I think the world would be better if this company exists? And if I don't care about it, I don't really, want to, like, why would I want to spend my time and energy and money and effort into this, right? And I think you'd be surprised at how often I get a deck and I'm just like, I don't really care. Like, even if this thing exists, even if it can make me money, like, I don't really want to be a part of this. I think it's immoral, or it just doesn't excite me. So, I think that's probably the biggest thing, is this something that I think I could get passionate about?
I think that's a really great gut check, right? It distills your combination of past experience and thesis and all of it into, is this, I mean, I won't I'll briefly tell the story of the worst pitches session I've ever attended. Came out of a very, very famous business school, where every single one of these pitches was perfectly crafted, had all the right buzzwords, was going to make a lot of money, and was completely passionless. It was purely about, studying the market for venture capital raising and potential exits, and putting together projects that that these founders had absolutely no connection with, other than business school exercise. But then again, I'm contrarian.
I get a
So-
lot of founders that do that too. Like, I'm really looking for missionaries, not mercenaries. And so if you pitch me on an idea and then you're like, oh no, but wait, I have another one. right? Like I'll get these people who send me like 3 different decks on LinkedIn that they're all working on. I'm like, this makes no sense. Like this startup that you're working on has to be like your obsession, the thing that you're putting like above like your relation. Like unfortunately, like if you're gonna really build something, you're putting it above your like wife and your kids, right? Like that's the level of obsession that like founders have with the product when they're building it. Not all the time, right? But that's what you look at, like, people like Elon Musk, they put their startup above everything else in their lives. And so how can you have 6 things above everything else in your life? It doesn't work. Um, and so
And
that's a huge red flag for me.
yeah, and just to put a finer point on that, because obsession is the right word. From a checklist standpoint, all the stuff Ihar said too, does it fit, mechanically, stage, all that stuff. But with this obsession part, I want to see that they're obsessed with the problem. Because a lot of times we'll see, hey, look, my product is amazing and you should see all the stuff it does. And like you can be obsessed with that, but it's not a business until you're solving something that you're obsessed with, and it's going to change. So a really focused obsession.
I think that's a super important point, which is that you can build the best technical product, right? I've seen a company for review recently where we had a couple of founders who looked at the logistics and trucking problem from a computer science perspective and said, here's how we're going to solve this for the United States, right? We're going to solve all these LTL trucking issues. And they had no experience whatsoever with how this was actually going to work with the people who are part of who they needed to solve it for. So, being obsessed, but also understanding what they're going to solve. It's not about the technology. It's about how it's actually going to be applied, how it's going to connect with the users, and being able to articulate that in some way, being able to have that strategy, or at least we know it's going to go sideways in the path between a pre-seed and eventual product, but we want people who understand, at least have passion for the problem they're solving. Ihar, you want to add anything to that one?
No, no. I'd say there are a lot of questions, so happy to basically things like one person answering one question could.
Yeah, let's do it. So LATAM, US investors, I mean, Decel Partners has a number of LATAM funds, and who are really focused in LATAM. I think, Ali, do you want to take that one?
Yeah. So, um, I think especially for like a fund one, it's probably less about the geo and more about the GP, right? And are you able to get people to believe in you and what you're building, right? More than anything else. So, um, I find that US investors in general tend to be more open geographically than almost any other region of investors. And I actually find that a lot of Latin American investors don't want to invest in LATAM. And most of my LPs that I see are actually that are excited about Latin America are actually from the US. So I think there's a big opportunity to tap into that. But again, it would depend on, Latin America is such a big, broad topic. So it really would depend on, who you're trying to talk to, what your thesis is, how it relates to everything else. Like, if it's just a Brazil focused thesis, then some investors get more excited by that. Some investors get less excited by that. If it's specific sectors or segments within Latin America, right? Again, so I think that there's appetite, but it's about, you kind of proving yourself as somebody who's a good GP to do that really resonates with that audience.
I'll add two things. One is that LATAM isn't one country. And the other side of this is that if, at least as far as seeking investment out of the US, that having a Delaware C Corp really lubricates everything, right? Because, the investment structure, at least as part of a number of funds, you especially as an early stage fund manager, you need to simplify your financial and operational challenges, and investing in vehicles that are outside of the US, if you're a US fund, can just be complicated from a tax perspective. So if the company is serious about raising money out of US investors, they're going to either structure with a Delaware C Corp, or they're going to have that in their material and say, if we get this investment, we're going to restructure with a Delaware C Corp. But it's almost a prerequisite for most US investors. Let's take a look at other questions here. Let's see, what else do we have? Any other ones that we want to pick up on? Anybody? We've got a question about customer validation and revenue at seed or pre-seed, right? I mean, pre-seed is generally defined as pre-revenue. So, it's clearly higher risk, but we're looking for, funds are generally looking for that resonance. Anybody want to take that one?
We
What
just
customer
want a little bit of revenue, just because I want to make sure it's not somebody's uncle financing someone's obsession. So it's a real customer, and it's just a little bit of validation. They don't even have to have, like, there's no way they're going to have the product all the way there. Certainly can't do all the onboarding yet, but just some good indication that the problem they're looking to solve is real and can be monetized. So that's what we look for.
Yeah, I can add to that. So it's basically very for us, it's very important to have at least one of two. Either a very strong track record from the founders that they have sold to the similar customers before, so we can see that, okay, they have the relationships and they know the problem, or they have actual interviews. So we like situations when there's a pre-revenue, but they have 100 customer interviews. It may be they might have some summaries and results from this. They may have one or two LOIs, or at least like excited emails from customers saying that we really would like this product to exist. This is kind of what we need, right? And where we don't invest, if it's just an idea that has no validation.
So I want to thank everyone who's been on the panel, Jonathan, Ali, and Ihar. Appreciate your insights. This has been awesome. And if people want to follow up, we've got VC Lab sessions for founders. We're opening, I believe, a new sign up for the next cohort on govclab.com. Hit that one. Check out all the various socials for VC Lab and for Founder Institute if you're a founder. And thanks again for our panelists, and thanks for jumping on. I love this session, and good luck with deal flow, and always looking for interesting deals. So appreciate it, everyone.
Appreciate it. Thank you, everyone. It was great.
Yeah.
Bye.